And there's this other fascinating part of this mortgage rate cliff that I'd love some insight from you as well on. Like when someone has a PPR, let's say, and it's their own place they live in, they go from this 2% rate to this 5% rate. There's no rental income or rent increase coming from that to offset it. So it's the household budget that gets impacted. It's the earnings on that household. Where when an investor has been hit with this potentially same circumstance, we're also experiencing like rent rises going up substantially. So they're not necessarily seeing the impacts in the same way. Now, this might be a question I haven't prepped you for, but I'd love to know, do we have any insight or knowledge on like how many PPR type PPR or investment loans are on this type of fixed rate thing? Do we see that it's going to be more something that impacts the households or the investors? Like, is there any knowledge around that?
Well, observations on a principal place of residence or your own place versus an investment. I don't have too much data on the differences of how many billions of dollars or the percentage of coming off fixed rates. I've got the global numbers of hundreds of billions of dollars coming off fixed rates, and even one of the major banks being $53 billion is going to roll off next year of the fixed rates. What I do find is the mentality of owner-occupieds versus investors is very, very different. So we talk about we need shelter, we need food, we need sleep, and we'll do everything we can to keep that safety for us. Or we can put it in Maslow's hierarchy of needs, if we want to get a little bit psychological there, is safety is our second to sleep and food and that level. So we're always going to find that we're going to be repaying our owner-occupied, even if it goes up by $500, $600, $700 a month, we will usually find a way. Or we might start to change strategy on it. We might go and rent out our current house and get rental income where there's a mortgage. Because still at the moment, we're finding that rents in some places, personal situations determine where that is that rents can be a little less, whereas you can get a mortgage paid via a renter. So there's a few different strategies you can bring into it as the fixed rates come off.
So just an idea there, if someone really falls into trouble, before they're going to sell their home, they might go live with their parents, for example, and then rent the house out. And they've still got the income from the job. They've now got this rental income. They're going to ride through this time and potentially be able to get back into the home. And then the second thing is, as you mentioned there, is because, I think the embarrassment and shame of losing your home is so high. The idea of that happening is that we would happily not go out for dinner or cut spending in other areas or sell our car before we would lose the home, right? It's something that's like the last line of defense. It would take a lot for someone to, cross over that barrier in itself. So really interesting points there just to consider on like moves people can make. The other one I wonder if you're seeing a bit more of, I imagine that if someone's had a house for let's say someone's had a house for 5 years, likelihood of having some equity in the home would be high, and potentially even the ability to refinance that home, pull some equity out and then use that as a buffer to ride through this time or to make other changes as need fit would be a strategy that could be done here as well.
Well, looking at some strategies to sort out this fixed rate. If you're not prepared, or you're partially prepared, or you didn't realize the variable rate was going to be up this high, things to think about is have you squeezed the bank as far as you can? Like, keep asking. I keep asking my bank until they say no. I've deployed some resources into my business to help reprice all my customers to make sure that we're squeezing them as far as we can. If you're got a 25-year mortgage or even a 20-year mortgage or a 15-year mortgage, there might be an individual personal circumstance that you might want to move that back to 30 years. You might want to increase the equity cash resources that you have to get through this time. You might have other things like rental increases, as you just mentioned. There's other costs to decrease. You might, if you don't need the second car, if you've only got your own place, where's your second car? Do you need that? The credit cards. Now, when the lenders look at things, all the buffers are not just at the headline rate. We talk about we're going to pay 5%, and then the banks are going to assess you at 8% because they got the 3% buffer. But it's all the other stuff inside. What is considered non-discretionary spending, private health insurance. Not that I'm advocating anything to change in that area, because that can be quite important.
Do you know what, Aaron? We're definitely not allowed to give financial advice. I feel even less qualified to give health advice. We should steer well and truly clear of that one.
So private school fees and private health insurance are over and above the living mechanisms with some of the lenders. Credit cards, some lenders will treat credit cards at 3.8% of the limit to 4.5% of the limit. So reducing credit cards, reducing other debts that you have outside the mortgage are going to significantly enhance what you're going to be able to do when you change from a fixed to a variable rate going forward. So it's not the headline rates or the borrowing that you have, it's what the buffers are inside the calculators. And that's where the competitions derive with the banks, because some will choose 75% of rent to income. Some will choose 45% of your credit limit on your credit card. Some will take the actual repayments on your car loan. Some will have a buffer on top of that. And some will treat others' debts better than their own debts. So it's not just the headline rate. It's what's inside the calculator and what you can do to rein in your own expenses there as well. Offset accounts is another one. I love offset accounts. You can just throw a buckload of cash in there and save a buckload of money as well.
All right, fellow property investor, if you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.